Right. So we've spoken about the macroeconomic theory basics in Unit 1. We've spoken about the role of savings and the IS curve and the LM curve in Unit 2. And now we're on to Unit 3, which is about investments and financial markets. And here, really, I'll be talking about the decision rules, how we make decisions about where to invest and how to invest. And I'll be talking about the financing hierarchy. So the reason why this is quite an important aspect of, as relates to Nigeria, is because historically we've had really high rates on government treasuries. And this has really affected people's or companies' willingness to invest in the real economy. So what the CBN governor has done recently is found a way of reducing the way that, or the amount of money that companies can make or people can make from treasury bills. He's excluded a large proportion of the Nigerian private sector from buying treasury bills, and I'll explain kind of the thinking behind it. So I'm not going to say whether the CBN is right or wrong. That isn't really my point. As I said at the beginning, the point of making this video is just for you to understand the thinking behind it. If you want to get a grounding in basic economics and really understand why certain decisions are made, then these are some of the things that we have to know. So Unit 3 is all about decisions, man, how we make our financial decisions, how companies make their financial decisions, and the effect on the wider economy. So this looks really boring and really difficult, but capital budgeting is really how people, firms, companies allocate money. And there's really three ways that they do this. Decide whether a new investment is worth pursuing. They use internal rate of return, they can use payback period, or they can use net present value. So when they use the internal rate of, let me start with the payback period. The payback period is like maybe one of the more crude methods, where they just, look at how long it's going to take to pay back the money. So when you're going, let's say that Dangote wants to build a new factory, he's just looking at, what's the payback period for that factory. A sort of more nuanced way of doing it is net present value. And net present value is calculating the future value of the project and dividing it by 1 plus I over n. So what they do is they consider the interest rate and they consider the number of years. And this is like one of the most famous ways of making decisions in financial decisions in companies. Now, the thing that I'd like to point out about net present value is the interest rate, or the WACC, the weighted cost of capital. So the reason why the interest rate is considered is because they're comparing the return on that particular project. I'll keep with the theme of an extra Dangote cement factory, and deploying the cash that would be needed to do that cement factory over the return on treasury bills. Now, I said that net present value is one of the most common ways that firms make capital budgeting decisions. So you can imagine in the years when treasury bills were 18%, risk-free. So you can literally sit down in your house and make 18, 16, 15% for doing absolutely nothing and taking no risk. So you can see why when we had very, very high interest rates on treasury bills, people weren't investing in Nigeria. It made the idea of putting risk capital into a project so much more difficult to make that decision, because when the rates
of treasury bills are very, very high, and you have high interest rates for just putting your money in a risk-free government asset, you're a lot less likely when you use these decision rules like internal rate of return or net present value to find real return on investment, calculated return on investment, compared for any project compared to the rate of government assets that are virtually risk free.
So now Tobin's Q. Tobin's Q is really interesting because it's the market value of a firm divided by the book value or total assets of a firm. And the general advice is to buy when the Q ratio is low and sell when the Q ratio is high. So if you notice that a firm has really, really great expensive assets, but what the market has valued the firm on this, perhaps let me give you the example of the Nigerian Stock Exchange. The total value of the firm is quite low compared to the actual book value, the amount of profits, revenue, assets, hard assets that the company has. Then you know that the company is probably undervalued. It has a low Tobin's Q, and that's generally the best time to buy it. But you know, our tech people have kind of made this quite difficult because sometimes the market value of a technology firm is very, very different from the book value and the total assets of the firm in the traditional sense. So I think there need to be some new theories developed in economics to account for sort of the way that the market has changed and the way that technology companies have kind of skewed this a little bit. Hierarchy of finance is also a theory that's really important, and I think it's something that people don't really think about that much um, when they're thinking about how companies make financing decisions. So the hierarchy of finance is a theory in economics that tries to describe the decision-making process for companies, the types of finance that they would rather take when they are sourcing for finance. And again, you know, these are quite old economic theories, and they're theories, and they're, you know, applicable to traditional companies, but not always applicable to the newer tech companies, but definitely via traditional companies. Most It's the pecking order of theory of finance. So it states that companies have sort of a specific order of preferences when they're taking finance, and the most preferred method of finance is internal finance. So finance from their own profit that they've made in the year that is now invested into the company. The second is external financing through debt, which is taking on debt from a banking institution or a non-banking institution, and that would be the second preference. And the last and the most unfavorable sort of method of financing is equity. So that's really the hierarchy, decision-making hierarchy that firms take when they're making financing decisions. Yeah, again, like a lot of theories in economics, like the tech companies have turned that on its head, kind of. So, the way that the venture capital world works, and I work in the venture capital field, it's a relatively new asset class, and there hasn't been so much written in the economic literature about it. But you find that technology companies actually often prefer equity to debt or internal financing. Finally, in this module, I'm going to talk about the debate between the price of finance and the quantity of finance. So this is like a massive debate, right, in economics. What affects this companies' decisions to invest more? Some economists say that it's a price. that if you're willing to pay the price at any price, then you can get credit. But in Nigeria, I think we've had a different experience. The total amount of credit available is just not that much. So there's this debate between, is it the price of finance or is it the quantity of finance? What constrains companies' growth more? And I actually think it's a mixture of the two. When the price is too high, interest rates are too high, then that's problematic. But also there are some things, some economic phenomena, which we'll be discussing in the next few units, that also affect the total quantity of credit available at any price. You can't get it. And that also affects companies' decisions to invest. So, quick note about capital accumulation, because this is really important for Nigeria. In economics, capital accumulation is often seen as the same thing as investment. It sort of means real investment in sort of tangible means of production. So how much real investment is going into tangible means of production of goods and services. And capital investment obviously happens, then that investment leads to profit, and profit enables more capital accumulation. So it becomes a virtuous cycle of investment. And why it's so important for Nigeria is capital accumulation is really the basis of wealth for any company that wants to achieve development. Capital accumulation is so important for development, and most of the central banks' current policies are really trying to push reluctant Nigeria into this virtuous cycle of capital accumulation and investment in tangible means of production. And how do you calculate capital accumulation? It's gross investment, so the total amount invested minus depreciation in any physical assets is equal to capital accumulation.